On that same point, I was guilty of this as well. I think a lot of people are in macro as well. You look at the US, you think, oh my God, they're printing so much money, we've killed the bond market, etc. The stock market must go down, right? Has to. Like, it never does. It's always high. I call them perma bears. I used to be one of them. Always wrong, me included. So let's change one concept of value investing. When you buy a stock index, you're not buying and holding. Let me get that very straight. When you buy a stock index, you're momentum trading. The stock index in 1980 looks nothing like the stock index in 2022. If you bought that 1980s AT&T, Exxon, IBM, if you bought the individual stocks in the index, you didn't make much money. You probably lost money. A lot of these stocks don't even exist, right? What happens to an index? An index balances quarterly or some periodically. What does that mean? When you're winning, you get more weight. If you suck, you're kicked out. The new person comes in. Every quarter, the index kicks out the losers and buys in more winners. That literally is the definition of momentum. So when you're buying a stock index, you're literally buying basically the winners of a certain country doing more or less. So if you're shorting it, you're not shorting the stocks, you're shorting a country. You're shorting the momentum of the country, which is very hard. It's forget it, it's not gonna work. So if you look at how even on the chart on the left, 2010 versus 2021, the composition of what's in the stocks have changed massively. If you look at IT, 17%. Oh, actually, the bottom six, right? We know who those are: FANGs, Amazon, Netflix, Facebook, Google, etc. They've gone from nothing in 2010 to being a huge part in 2021 because they're winning so much. So your index changes. You can't just short the index because your weights are changing. You're shorting a momentum. You can never short a momentum index. You're asking to die. And not just that. People look at, oh wow, the index looks expensive because PEs are high. PEs are high because you change the composition. More and more IPOs in the last 10, 20 years was from tech. Tech companies don't make money. Most of them don't, right? So, but they're high growth. So on a plain value PE basis, the index looks more expensive because you're changing the mix of a boring car company or manufacturing company into ByteDance, for example. Obviously, it's different because it works with a different valuation metrics. That's why value investing has underperformed so much. And bears have been so wrong. And not just that, I've said this many times to guys on my team, but please remember the stock market is not the economy. The stock market has nothing to do with the economy. GDP contribution is on the left, mostly government. Jobs is in the middle, mostly government, a bit more healthcare. S&P composition in 2020 is on the left, no government, all tech. What happens to GDP and what happens to employment doesn't matter for stock market. If you look at the stock market, all you really care about is what's tech doing, 40%. Tech has nothing to do with GDP or employment. They have their own way. So you can't just say, I'm very negative on the economy. I think they're gonna do well or no, blah, blah, blah. The S&P doesn't care. You're looking at the breakdown of the sectors. You gotta remember what you're buying. You're not buying the economy. The economy is mostly government. You're buying public companies in a balance that they do themselves. So be very clear what is that you're buying, or shorting even. And on the right, I don't know what to say, but US companies are very good at making money. This is their earnings per share. What can you say? It just keeps going up. Whatever they do, they just make a lot of money, recession or no recession. So why would the stock market go down? They are making money. Yeah, you kick out losers, but the point is, the way it works is the index keeps making money, or index constituents. And not only are they making money, the supply is shrinking. The chart on the left, IPOs, there are much less IPOs post.com than pre.com. It's staggering how few IPOs there are. There's no supply because big companies eat small ones now. In the old days, we had a lot more small companies. You have more stocks to buy. Now the big ones just keep, even in China and US, everywhere, you have much fewer companies going to IPO. And second, and I'll cover this in private equity, a lot of companies don't even bother going public. I'll just stay private. there's tons of money from Sequoia, Hill House, Vision Fund. They just give me all this money in private markets. Why do I need to IPO? I don't want to report. I'm not going to go IPO. I'm not going to issue. So there's no supply of IPO, or very few stocks being available since 2000. Second, as you know, US corporates keep buying back their own stock. Remember, you and I can't borrow rates at zero. Apple can. Google can. US corporates can. They borrow rates at zero and they buy back their own stock. Free money, right? My stock makes 15% ROE. I can borrow at 2. Free cash. And my personal bonuses are based on my stock price. Great. Buybacks in US have been going up higher and higher while supply is shrinking. To make it worse, remember our pension buddies at the top. Pension every month goes, I need to buy some. Guys are retiring, I got money, I need to buy. I don't care what price it is, I am buying. Whereas when you have so little supply, so much demand, what happens to stock prices? It's simple, right? Like there's no supply. So we talked about the private side. Not only is there no supply, but private equities have become a bigger and bigger focus, maybe in your classes or maybe things you read about. It's becoming a bigger part of how economies function. It's grown, from 1 to 10 over 20 years, and it estimates to be 30 trillion by 2030. So these is basically saying, remember when rates are zero, people say, I don't need my money today, I'm happy locking it in private assets for a long time. So people are looking for increasing places for extra alpha, extra yield, and people are more and more willing to go to private markets even though there's very few liquidity. And what happens when all the money piles in? We've heard about WeWorks, we've heard about FTX, all this kind of stuff. Not only are the private companies paying more for private companies, EV versus EBITDA as a measure, enterprise value versus EBITDA. They paid up 50% over the last 10 years. They've also done no due diligence. Look what happened to a lot of these WeWorks and kind of tech companies, because there was so much frantic demand to invest in these private companies. People do very little work. They pay a lot more, but that has an effect too. When you pay so much in the private market, when they IPO, you have to IPO at a higher level, right? If your cost is already 13x EBITDA, you gotta have the IPO at 16x. There's no choice, or you can't IPO. So the valuation premium in private markets are jacking up or pushing up the public market valuations. Again, this has changed a lot in the last 12 months because rates have gone up a lot. Remember, rates is the price of money. You change everything when you change rates. But for the longest time, rates were zero. The Fed was creating this sort of behavior, externalities that they weren't aware of. And this is a Buffett indicator. I know, a lot of people are big fans of Buffett. They often talk about this being unsustainable, which is corporate equities to GDP. It must mean revert. I have to say, in macroeconomics, not everything mean reverts, especially when you change the rules. If you're a momentum index and you let the winners stay and you kick the losers out, and the half and half-nots of the world keeps growing, the bigger just keeps getting bigger, smaller gets smaller, it doesn't have to mean revert, which means stocks don't really have to cheapen. Think of supply and demand picture. There is no supply. Too much money in the private market is pushing it up. Price indiscriminate demand from pensions and people doing well. So it goes back to the original point of capitalism. You're hoarding assets. It's really hard to short equities. It's really hard to be bearish in the long term, unless you make rates very high. We'll talk about that at the end, but remember, this is all. Race is the ultimate determinant of how much you pay or not pay for things. But if you leave it alone, you leave it as is, not everything reverts, especially not in equities. So I'm going to talk about, when I was in undergrad, they certainly didn't teach me this, but you might have heard, I don't know what the word is in Chinese, but in English, this word price stability is often quoted for the Fed. The Fed's always talking about we want stable prices, 2%. What on earth is price stability? This is a chart of $100 in US, price over time since 1920, deflated by CPI. Does this look stable to you? I don't know what looks stable to me. It looks like But if we zoom in, I'll tell you what's stable. The price of the devaluation is stable. When they say they want price stability, they mean the pace in which they devalue your money is stable. The US owns tons of debt. What's the best way to pay down debt? Inflate. Best way, right? You don't have to pay back. Just inflate it. But if you inflate too much, you become Argentina. You inflate too little, you become Japan. So what the Fed is a master of doing is, I inflate it just right. That's what they've done. So if you look at this Lehman GFC, this little kind of kink here, well, that can't happen. That deflated. Oh no, my debt went up. So that's when they say, oh no, deflation is taking hold. No, I need to crush it. So then they kind of go back here and they printed all the money. So that's going fine. Okay, deflation is still fine. Here, when COVID happened, it kind of went a little bit too fast. Oh no, now that's too fast. No, this is going to get out of control. We got to worry. So now let's hike rates. So look, in the short term, they do all these FCI stuff and whatnot to manage rates. But in the long term, what's clear is, I don't want to say money is worthless, but things devalue. When you have 2% compound CPI, now it's more like 5%, assets go up, stocks go up. Houses go up because money keeps getting printed. And remember, our entire GDP is dependent on how much money is being borrowed. We're constantly creating credit to keep GDP up. What happens when you don't keep GDP up? You lose your jobs, people revolt. People get in trouble, right? Governments fall out of favor, people go into riots, whatever it is. We're in a system where the denominator, which I call money supply, constantly grows. So short term, which is why when people say, I invest money, you make money in the long term, of course you do. Denomination grows, of course you make money in the long term. As long as the top part stays, you make more money, right? Because this happens to your money. If this reverses, the entire world is gone. Like, it's going to go into chaos. It's not going to happen. So what they say, price stability, stable devaluation. That's actually what they meant. So keep that in mind when you're thinking about how the monetary system works. So then going on that chart. So again, I mentioned this earlier, all of this kind of predicates on interest rates. So I'm not older than most of you, but basically since I was born, this is probably as pretty of a chart as you can see, technically speaking. The 50-year chart on where 10-year yields have done, going back to Volcker in 1980. So ever since Chairman Volcker defeated inflation in 1983, interest rates have gone down in a straight line. Beautiful. So again, if you remember what happened before, what happens when interest rates go lower? Price of money gets cheaper, assets get higher. Very simple. There's literally nothing else to say. But what happened in post-COVID? We broke the trend. So I think a lot of the benefits we had before on rates being lower, for example, China's been a big help to the whole world for keeping inflation in check, right? The world's biggest supply chain, keep the cost very low, people can consume. We're no longer the world's factory like we were 20 years ago, right? Our consumption is going up, we're making more money. So the low cost production is not what it used to be versus 20 years ago. Productivity, mostly gone low. People get expensive, labor gets, salaries are going up. That's also going worse. Peace dividend. Countries are less friendly to each other than they have been over the last 10, 20 years, right? There's less global trade, especially post-COVID, reshoring. All these are expensive. The deflationary or disinflationary benefits of globalizations are shrinking compared to years past. And low energy prices. As we know, energy is a rare resource. We do a lot of EVs and stuff. Rare earths and all this, there's also an input issue. So if this chart reverses, everything we discussed earlier will also have profound changes, because a lot of how we decide to spend, for example, right now, if you were living in the US, your deposit rates are 5.5%. To the average person, why would you buy anything? Just do a term deposit, get 5.5%, you're done. Don't buy a house. Why would you bother? What if rates are like 8%? There's no crazy runaway inflation. You just leave it at the bank. Why would you do anything? You don't need to invest, right? Don't take any risk. So depending on how rates do in the next 10, 20 years, which is why we kind of cover this topic, You will, or if I go back to the tech example, when rates were zero, as an investor, you were very patient with certain tech companies. Oh yeah, take as long as you need, 10 years, 20 years to make your money. But if that's not the case going forward, because, hey, I'm getting 5-6% a year in my deposits, you better make money soon, right? Or I don't want to invest in you. You won't have the same type of companies who are able to take their time to kind of get market share before making money. The pressure to make money becomes earlier, which means the companies that survive in this cycle will be very different than the last cycle. Profitability is now more important. It's going to be a lot harder. You won't want to buy a place to rent because your rental yield might be 2. You have all this hassle. Again, just put it in a bank. It's okay. So depending on what this interest rate range does the next 10, 20 years, that could have profound kind of implications on what happens to us. And as a final bonus chart, because as I mentioned, SignalPlus is a digital asset platform. We used to joke that when an asset becomes mature, interest rates are affected. So the dotted line is where what we call terminal rates are. Basically, you're pricing where interest rates are going. The peak interest rates will be, think of that as the interest rate line. Green is gold, yellow is Bitcoin. The Bitcoin price looks exactly like the interest rate chart, flipped. Which makes sense, right? If you're becoming a mature asset class, more mature, if interest rates get higher, price of money goes up, the other assets are less attractive. Bitcoin goes lower. Reverse is true. So for an asset, that should have nothing to do with where you think Fed forecast, and I'm sure the average person trading Bitcoin is not thinking about this, or even gold. But the reality is the reality. Macro is very interesting. When you have all these buyers and sellers coming together, the result is, it is what it is. So, in closing, this is the final chart. I generally just like to say that interest rates is something that's very boring to people. They don't think about a lot. But actually, when you really dig down to it, the one thing that compels us to invest or do different things is actually the function of interest rates. So, in your journeys, in your careers, wherever it might be, kind of having at least a sense of where interest rates are going and what it means for your decisions is probably helpful for your own personal investments. It's something that all economies and central bankers have to focus on because it is effectively the lifeblood of the modern economy. And on that, thank you for your time. It's been over an hour. Happy to take some questions or whatever you guys might have. I can't take the ones online, I'm sorry, but happy to take questions here. Thank you.
To the chart where the mortgage rate is 7%. So
7% mortgage rates. Yep.
yeah, and then the reason why people can actually pay up to that high mortgage rate and still grow, isn't that because 45% of people's saving are in equity, and equity is going up?
Yeah, but equity has no cash flow. You can mark to market high, but it's not yours. So what's actually happened here is, where's that chart on the jobs? They've been making wage growth. If you look at wage growth, they've been going a lot. The Fed keeps talking about Fed wage growth. In the U.S. market, the labor market is crazy strong. There's anecdotes where you can't hire a waiter, you can't hire a cleaner. People just simply don't work because the job market is so hot. So I think there's a combination. One is the job thing, and second is I think the U.S. Homeowner is actually pretty savvy. A lot of them locked in interest rates lower. So when rates were going up, this is what I'm talking about. They actually pay attention to the news. When the news is like, oh, the Fed might have to hike rates and do stuff, they start locking in the fixed rates. So the U.S. home buyer is actually very sensitive to where interest rates are going because the bond market is so big as part of the daily life. So I would say on that case, the U.S. homeowner is actually a pretty decent investor in locking in rates. Yes.
I have a question. Slide, you mentioned that when rates go and stay at zero, people may
Which one? Which one is that?
the rate go and stay at zero, and some people should buy long term.
Oh, okay. Yes. Sorry. in the Yep, go ahead. Here. Yes. So if things are volatile in the short run, but you're long-term, if you're like a pension, you buy for 10 years, you're not supposed to look at it. You're supposed to buy and forget. So precisely to your point, if you don't care about your money because it's zero, you're willing to not worry about the fluctuations as long as you think it's worth something in it. Like you have to believe that it's worth something in the long run. So it's exactly your point. You're willing to take more risks. You're willing to ride the ups and downs because you don't need the money in the short term. The money is, you're thinking, my money is zero in the bank anyway. Why don't I just leave it and not look at it for a few years? So you start becoming willing to take much more risky bets into assets that are like this that you wouldn't consider otherwise because you think ultimately it's worth something. Yeah, so maybe I say this way. If you had $100 in your pocket, but the $100 was worth a lot to you, like you can't afford to lose it, like you might need money in the next few weeks to pay for bills or whatever, and you were forced to invest, you would invest in a very safe asset. Because I don't want to lose this money in case I need it the next few months, right? But what if it's the opposite? I really have $100, I don't really care, but I want to maximize what it makes. Then you buy the one thing that you think has a lot of value, but in the meantime can do this, like kind of up and down, because I don't care, I'm not looking at it, I don't need the money. So that's where that needing part comes in. If rates are zero, you feel like you don't need the money. It's just sitting in a bank doing nothing. When rates are 5, again, the price of money, right? Inflation, all this kind of tax on savings kind of concept. When rates are high, you feel like it's worth a lot. So you don't want to just let it be. It's the psychological behavior that affects you. Let's go to the extreme. What if rates are negative? Oh, please take it. Just put anything, just take it away from my hands, right? Like kind of like when in Argentina or Germany in World War II, rates went to like money was worthless. Oh, please buy me a piece of bread. So it goes to your point about risk taking. The lower the rates are, the more risky you're willing to do, and the more volatile assets you're willing to purchase, as long as you believe in the long term. Thank you.
Can we go back to the QE part and how
This one?
我没有搞清楚这几个表里面那些就是老师你刚刚在说到它这个 QE 它是一个比较失败的实验的时候，它就是正常它做了一个 QE 的行为，预期是怎么样，然后实际上市场是做了什么样的表现？这个对比我想再了解一下。
Okay, so if you remember, the Fed's job is they want to grow GDP. And we already established that GDP is a function of how much credit or loans there is in the economy. So if you want to stimulate the economy, outside of just printing cash and say like you get $1,000, you get $1,000, you're trying to increase borrowing availability. That's the starting point. So what the Fed's trying to do is, if I expand my balance sheet, if I borrow, if I'm the Fed, I borrow, and I go to you and I say, I'm gonna buy your computer right there, and I'm gonna give you the cash. I want you to take that cash and lend it out. I don't want you to buy a computer back. I want you to use that cash and give to Chris or give to Jaja, and then they can create a business or something. So that's the idea of QE. So again, on number 3, what they wanted to see is that minus 100 treasuries, positive 100 reserves. They want to see the next step, minus 100 reserves, plus 100 loans extended. That's what they actually want to see in step 3. But instead, they didn't do that. They just put it back as deposit. They didn't lend it out. They just gave it back to like, oh, another bank and I get some free money. So you recycle. So you basically went and either bought the same computer back, you bought the treasury back, nothing happened, right? Or you decide to just leave it at HSBC. So nothing has created. But what you did create was this, right? To use the computer example, you went back and bought another laptop. The next person, so you bought another laptop. Then you ran out of laptops. In this case, the laptops are bonds. You ran out of bonds because you kept buying the bonds. So that's why you had negative debt. When people always ask, how can debt go to negative? Who in the right mind buys negative yield debt? The answer is the banks who are regulated, who are not allowed to buy anything else except those assets, that's all they can buy. Even if it's negative, they must hold that for the ratios, right? They have to pass a stress test. So what the Fed wanted to do is they want to create more loans in the economy, which leads to more startups and private activity. Instead, what they do was they ruined asset prices. They caused asset prices to have these kind of weird fluctuations. And instead, you as a bank didn't end up funding the private companies. Private equity did. That's why private equity exploded. Because I'm a startup, I can't get money from Goldman Sachs or JP Morgan, even though rates are zero because I don't qualify. Just because rates are zero, they won't lend to me. Private equity will. Because you as an investor might say, well, my money is doing nothing. I will give my money to SoftBank or Sequoia. Then they have all this money. Then they're really, okay, sure, I'll spray some in startup. That's why all the WeWorks, all these crazy companies came up. Because they're willing to bet on these companies. So what they ended up creating was making the banks become more carry traders. The banks end up putting money back into the accounts. And they effectively turbocharged private credit and private equity market to become actually the main funder of startups, which is what we see for us today, right? That's actually, the bank's not the ones giving us the startup loans. It's the private enterprises. That's what they've created. No, that's a great question. In case for those who online didn't hear it, the question was the government overstimulated during COVID, and now they have to unwind it. How much further do they have to go? I mean, the honest answer is nobody knows. Because if you look at how much they expanded the balance sheet, it's beyond astronomical. It's almost like AI self-learning. You don't even know where that money has kind of sitting now. But what they do say now in their speeches is, for some reason, the US job economy is much stronger than they expected. The people just keep getting wages. That's why they've been hiking rates as much as they have, number one. Number two is if you look at stock prices, even today, stocks are high. Like the company's doing very well. AI's come now, another new narrative. So on the margin, I think the only thing people can say, if you look at the UK, inflation is very sticky. People assume the hiking will be longer than what people originally thought. But nobody knows what the number is. But I think if you ask most people 2 years ago, would US rates be 5.5%, UK rates close to 6%, European rates at 4%? People probably say no way. And by the way, things will probably crash if that happens. But now that we're here, asset prices are still high. My personal view is they will go longer than people assume, but maybe not so fast. Like they might be scared to like crush it, but they might be like, you know what, we're really going to hike, but we're going to take a long time. But I think the main takeaway, Zha, is they probably won't cut. So I think people assume they will cut and ease and do QE. I think that's not happening. So investors' expectations that they're going to cut rates and asset prices will come back, I personally feel that is not happening, because the other consideration is next year is an election year. The worst thing for a US consumer is inflation. It's actually not stock prices. If the average American goes to say, oh, my grocery is up 30%, Wall Street's making a lot of money with stocks, my jobs have gone up, but it's not that much, and I'm bleeding all this money in inflation, the Democrats will have a lot of problems to explain to the constituents why is the policy here. So I think net, their biggest concern is having runaway inflation. A bit of slowdown is probably okay because the job market is so strong for now. So if they were just blindly to have to choose choice, they probably will lean a bit more cautious than to ease. So again, it doesn't mean they hike like crazy to crush it. Nobody wants to crush the party. But I am a big negative, or I'm not a believer that they're going to cut anytime soon. So it might just be kind of like flat for quite a while, which is very difficult for many markets, right? Like even startups or companies. Wow, if 5% is going to be the base rate, is no longer zero. That changes your idea of what's a riskless rate. No, that's a great question. So there is a relationship. For example, let's just imagine if rates was 10% tomorrow, probably most companies won't make money. That's for sure going to happen, right? I think what we mean to say here is, if you look at the S&P here today, so the majority of the gains this year is the AI stocks and maybe Tesla and some of the other ones. So if you're strictly talking about the S&P only, then you would say if the Fed was to keep rates high, would that affect the consumers to buy Teslas? Would that affect their ability to pay for certain products? And how much of these companies' earnings are contingent on easy money policy, or how much of their stocks are they buying back? It's a much deeper conversation. That's where you go into the stock and actually study it. In general, what I can advise to the person is, on a day-to-day basis, it won't matter, but on this chart here, if I go back, I would, where was it? Where was the chart on the PE? Oh, there we go. This is what they should think about. It doesn't affect the S&P one-to-one. It affects the multiple of what you pay for the S&P. So if the interest rates become very expensive, generally you would pay a lower multiple. But if the company is so strong, they make tons of money, then it doesn't matter, right? I mean, they're just making money. So that's kind of the complex relationship we're dealing with. Macro is not one-to-one. There's no such thing. But if they're thinking about looking for jobs or actually just a career, that's different, right? Macro, definitely, you want to go to the hot sectors. But that's why we always say, generally, especially index like S&P, you just generally close your eyes and buy for the long term, because they have always said, not time in market, not timing the market, because generally things go up. You don't want to time the market. You just want to stay in the market, because as long as you think, in this case, whether it's the Chinese economy or the US economy, as long as the economy is innovating, the system works. And because it's a momentum index, right? The winners stay, the losers get killed. As long as you think innovation is happening, generally the index will go up. And that's kind of what I would advise him to focus on, rather than, like, if you want to trade kind of like interim, then it's a professional job, right? A lot of us came from Wall Street, you do that 24/7 and we still get it wrong. It happens all the time. So I would just generally advise people, kind of like the pension thing, you split up your investments and you just do regular things and you kind of forget about it. You don't just buy the right sector or the right index, so to speak. If it's just month to month, quarter to quarter, that's a completely different discussion.
So what about crypto? You know, a lot of audience here is about,
Sure.
you know, is working on this Web3
Yes, yes.
and crypto, and they focus on the, you know, artificial intelligence or the crypto market. So
Sure, sure.
what's the relationship between macro economy and crypto buyers? And a lot of analysts on Twitter will show the S&P and other indicators. So what indicators matters for crypto buyers?
Sure. The question is how does interest rates or macro indicators affect alternative assets like crypto? That's the question. I think all the Twitter stuff, they're just picking short correlations that look nice, but they don't actually really function. If you actually, AI and crypto are a bit different, because the people investing in them is different. I would say two things. One or three things. One is, in terms of investment into the space, it's venture capital. Both AI and crypto were funded by venture capital money, right? Crypto companies don't really have a very good business model. For most of them, it's just tokenomics. Like, you know what we mean. AI has no business model. It's just, let's make some toys. It's gonna be great. So it needs to be funded by VCs. But the VCs get funded by the investors, like ourselves here. Your propensity to put money into a VC to buy a Web3 product or AI is also affected by the interest rates. If interest rates are 10%, you probably won't put as much into these VCs, right? This is 10%. If it's zero, yeah, take my money, just, you know, do whatever you want. So from a funding perspective, in terms of developers and business models, your first stage is these industries will grow more if there's more funding, if rates are low. That's for sure going to happen. But on the macro side, I like to think of macro as more than just asset prices. There's a regulatory macro. As we know, the US has gone very anti-crypto on most spaces. So the thing is, even if the sector has a lot of benefits, US healthcare is a good example. When they regulate a drug or a process, stocks will die. The company might be strong, but one regulatory risk will hurt certain sectors. Same for chip making, right? That's a very sensitive sector now. So from the macro perspective, it's actually a lot more regulatory, because I think a lot of mainstream interest wants to go into crypto, like BlackRock's making the ETFs, Wisdom Tree, all these kind of people. But most people just don't want trouble with the law. If the regulator says don't touch it, then you don't touch it, right? Because it's difficult. I don't want to get in trouble. But if for whatever reason Wall Street becomes more warm to it, and maybe there's a change in SEC government, maybe when the new election comes, things will change. I don't know. I do not know. But regulation is probably now the biggest macro factor on this, because the short term, yeah, this price goes up and down. It doesn't really, but longer term, medium term, availability of VC money from the funding side, and participation from the investor side, which is probably more regulation. And when that happens, then I think you can look at these correlations. Then it becomes, okay, everybody's free, you can do it, you have more traditional type of stuff. But now, who cares about correlation? If the Fed or the SEC tomorrow says this is illegal, then it doesn't matter anyway, right? And who cares about business models when you barely have enough users to come in, because it's so early. So the VC guys need to fund you. So I would be careful using very mature macro indicators on brand new assets, because the correlation is less from a day-to-day, but more from like a medium long term of how the space grows.
Thanks for the lecture.
China's truly global export competitor. So he thinks that a weaker yuan would help both the Chinese exports as a expense of their Japanese competitors. So what's your opinion about it?
Yeah, for me, commenting on FX trade policies is always tricky. But what I will always say is, if you look at how the Chinese economy has done, consumption is actually now bigger than what it used to be. We're not just competing now on the lowest FX. Plus, if you think about, like, US is a big buyer of Chinese products. If the relationships don't improve too much, it's not so much about the CNY or CNH or whatever it is. It's about, do you want to build the next factory back on shore? Or are you okay to leave it here and buy as an export? So yes, there are some marginal GDP benefits of devaluation, but there are also big concerns, right? We have, I would say, a longer term preference to maintain a stable currency because we're trying to make it more of a reserve currency and give a lot of confidence to foreign investors. So I would think that the drawbacks of devaluation, especially against yen, to make some marginal GDP benefit from exports, it's probably not great considering all the downsides you will have from low consumption confidence and the way people think about kind of the yuan as a global currency. Especially, remember, we're trying to do all these bilateral deals with other countries now, trading in petrodollar, petro yuan, etc. Do you really want to be going out there and giving the impression that when something happens, I devalue the currency? That's against the longer term trend of making the yuan a more stable, acceptable mean of transfer with non-US entities. So I see that as a big downside, number one. And number two, as you probably know, a lot of the issues now with the economy now is more domestic as well. So the FX policy doesn't actually change the domestic issues that much. So I think people can all speculate on what that means, but I think his ideas are very, I don't know if the word superficial is right. I think it's one way to look at it, but I think it misses on all the potential shortcomings that like a bigger country will have to consider, and it's very sort of narrow, first order consideration driven. So again, he might be right, I'll be wrong, but I would be surprised that if that was an official policy. I don't see the benefits to be worth the potential drawbacks. Thank you very much.